for individuals, the big bucks, if you will, but again, it's if you can qualify, and so many of these provisions are tied to phase-out ranges based upon adjusted gross income, again, consistent with the administration's I guess, promise through the campaign and into the first part of this administration to provide relief to lower and middle income taxpayers. Probably the biggest issue, and we'll talk a bit about that more in a minute, is this new making work pay credit. There's a one-time payment for retirees, disabled individuals, and Social Security income recipients. Sales tax deduction for vehicle purchases, that was a big issue that was debated and discussed. At one point they talked about allowing interest deductibility on the purchase of new cars. They dropped that provision. They've inserted instead a sales tax deduction provision. As I'll talk about in a minute, doesn't do us very much, if any, good here in Tennessee because of the way our tax structure works. Expanded first-time homebuyer credit. This is a fairly lucrative provision, if you will, for people who are in the market for their first home, and it's a pretty significant improvement over the homebuyer credit that was enacted and was in place last year. AMT relief, again, designed to keep a big block of people out of having to pay alternative minimum tax. Some changes for college expenses, energy-related credits, again, for improvements to your home. And I'll talk about the COBRA subsidy. It has to do with health insurance, company-provided health insurance. Not per se a tax provision, although the way it's going to operate and the way businesses are going to get credit back for subsidizing is through a tax provision. Okay, did it go? Yeah, a little bit of the details. And again, please stop me at any time if you have a question about something. I'm happy to take those questions. I mentioned bonus depreciation. In the 08 Act that was passed last year, I think it was the Housing Act, they reinstated what we call 50% bonus depreciation, a provision that had been in place in 03, 04, 05. And they put it back in last year. They've extended it to apply in 09 as well, and it effectively says I can deduct as an expense up to 50% of the cost of qualified property that I purchased and placed in service in 2009. Again, the intention here is to provide an incentive for investment in property, plant, and equipment. Have to be careful about what it applies to. It doesn't apply to buildings. It does apply to equipment, furniture, and certainly leasehold improvements that are short-lived. So it's nice to see that they've extended that provision from 08 into 09. You have to be careful about this rule because you have to acquire the property and place it in service in 2009. And you have to be careful about when you entered into your contract. If you got a binding contract that was in place before the beginning of 09, and then you place it in service in 09, you're not going to qualify. It has to be, again, the incentive is to get people to invest in 09, just like it was in 08. Same rule applied in 08. If you had a binding contract in someplace in 2007 and you bought property and put it in place in 08, you didn't qualify last year. Same rule applied again this year. An increase in depreciation for business autos. Business autos is one category where you have to be careful about applying the top two rules or the top rule about 50% because there's a limitation, but they've increased that limitation. Again, all designed to incent people and businesses to make acquisitions. Other big area other big provision in the area of depreciation and expensing has to do with what we call the Section 179 limit, which allows a company or an individual to deduct the full amount of property, plant, and equipment acquired in 2009 over and above it's even more favorable rule than the 50% depreciation rule, and it's simply an extension of the 08 rules that increase the limitation. So you've got literally almost twice as much property that you can buy and place in service in 2009 and have that qualify for full expensing right up front.
I'm sorry. I think you answered it, but I'm a small business operator and I expense directly all of my purchases, whether it be equipment and things. you really confused the heck out of me on all that bonus 50% and all of that, because I've been able to take 100% of it up to 80,000, then 100,000, 125,000, and now it's 250. So I really don't pay any attention to that whole top portion, is what you're saying?
If you're down below that level and you want to make that election, this is an electable provision. You don't have to do that, and you probably want to look at your overall tax situation to see whether or not I'm eligible to take that, because one of the limitations on the 179 is I can't take it to the extent it creates a loss. So I wouldn't want to make that election if I can't. Now the bonus depreciation, I can take that election and make that expense, even though I might create a loss. That would be a loss that then I can carry forward or carry back. But 179, you have to be careful about whether you're going to generate a loss or not.
But doesn't it also depend on the life of the item you're purchasing?
Well, certainly, only certain lived properties, if you will, would qualify for either one of these provisions. It's not just any purchase that you make that's would otherwise be capitalizable and depreciated over whatever its useful life is.
Right.
But the longer lived property, and certainly real estate type acquisitions, will not qualify for either one of these provisions. Okay. The next category is, again, an extension of a provision that was enacted last year, and basically it says, okay, if I can't use these expensing provisions, I'm not going to get a benefit for those for a while. Maybe what I want to do, but I've got I paid alternative minimum tax in the past, or I had some research and development that created a tax credit that I couldn't use in the past because I was limited. The provision allows you to elect to effectively use some of that in 2009 instead of making an election to use the bonus depreciation or 179 expenses. So, for example, if I think I'm going to have a taxable situation in 2009, and I've got some credits to carry forward, I may not want to make that bonus depreciation or expensing depreciation election or use those provisions and save that deduction, let it go forward, and reduce my 2009 liability from any credits that I might be able to carry forward. So you're really just saying, let me use a tax attribute or a benefit that I've created in the past that I might not see the benefit of for a while, and let me use it in 2009. You can do it in 2008 as well, as opposed to using the more favorable expensing rules and just push those out. Again, it's just simply a tax planning. You need to sit down, I guess, with your tax advisor and look at what your situation is and try to determine which one of those elements would be more beneficial for you. Next provision is an extension of the WOTC, or the Work Opportunity Tax Credit. It's been in place for a while. We certainly look at that with all of our clients to see whether or not there are new hires that would qualify. Again, a difficult environment for this credit to be applicable because of where we are with employment across the board. But they've added two categories, again, designed to incent the hiring of these two targeted groups of individuals: recently employed unemployed veterans, and a category they call disconnected youth. And that's a very, very narrowly defined group. It's 16 to 25-year-olds, haven't been in education or haven't been employed over the last 6 months prior to the hiring. They are effectively unemployable because of certain reasons as enumerated. So it's a very, very targeted group that you can get this credit for if you hire. I don't know, obviously, how much benefit that's going to be, but certainly understanding the incentive behind that provision is to try to get a certain class of people, two certain classes of people, back into the employment arena and hopefully get some of those individuals working again.
How much is that tax credit? Do you have a
I don't remember.
percent of their salary? Or?
Yeah, that's the way it's done. I don't know if it's a percent of the salary or a flat fee per new employee. I think it's the latter. I don't have the details.
One-time credit or ongoing?
No, it's a one-time credit for the hires that occur in that particular tax year.
It relates somehow. The value to the business relates to the amount of total compensation provided to the individual. That's all.
I'm sorry. I'd have to go look those rules up. I don't.
No provision for recently unemployed investment bankers.
I didn't see that, but as I told you this morning, I didn't read through all the fine details.
Fine print.
I didn't see that, but there's a lot of stuff in that $787 billion, so there could very well be something in there.